Hi everyone, I'm Charlene Pemberton, and I'm excited to guide you on your financial journey. Whether you're looking to save, invest, or plan for the future, you're in the right place. Get ready for expert advice on budgeting, investment strategies, debt management, and real-life success stories that will inspire you to take control of your finances. Join me as we break down complex financial topics into easy-to-understand lessons, empowering you to navigate your financial future with confidence. Welcome to Navigating Your Finances, your trusted resource for mastering your money and achieving financial freedom. Hello, everyone, and welcome to Navigate Your Finances. I am your host. I'm Charlene Pemberton. I'm a financial educator, and I just have a passion for helping people to do better with their personal finances. Today, we're covering the topic of consumer credit, mostly known as debt. We're going to look at the purpose, the types of credit, good use of credit, misuse of credit, a get out of debt plan, and we're also going to look at basics on your credit report and on your credit score. All things credit so that we can do a better job and also be eligible for better credit, for less interest rate credit, because we're good stewards of our credit. So let's just jump right in. First, I'm going to talk about the purpose of consumer credit. And that purpose is that it permits us to use future income to satisfy present needs and wants, right? So when credit is extended to us, it enables us to buy things and then pay for them in installments using future income. Then let's look at the types of consumer credit that we have. There's sales credit, which is mostly credit cards, and that's for the purpose of buying goods and services. You know, we can use our credit cards and be able to purchase things and then pay things off later. And then there is the type cash credit, and that kind of credit we borrow money for the purpose of paying for a car, a home, or even funding a business from time to time. So those are the basic two types of consumer credit. Then we want to just look at a little bit about the good use of credit. Now, when we talk about buying to purchase something, a good use of credit is to borrow to purchase an appreciating asset. What is an appreciating asset? Most often, a home or a place to live is an appreciating asset, or a business, is sometimes an appreciating asset. So why is that good credit? Because when you purchase the item, it generally will cost less than what it is when you finish paying off the debt. Let me use the example of a home. So you may purchase a home at $250,000. Most often, a home will appreciate in value. Certainly, we have seen times, and in our lifetime, like around 2008, 2010, we saw homes depreciate because of the mortgage crisis, right? But most often homes appreciate. So what happens, and when I say appreciate, let me just straighten that out, just saying that they increase in value. And someone's talking to you about appreciation asset, that's an asset that increases in value over time. If they talk about a depreciating asset, blah, 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 you're talking about something that it decreases in value over time. And cars, various things that we purchase, while they're useful, they do depreciate over time. So when you talk about appreciation appreciating asset. Say you buy a home at $250,000. When you go to sell it 10, 20 years later, it's expected that it's worth more and you're able to sell it for more. So then you come away with equity or value in the home. And that could come, you can come away after closing costs and stuff with money in your pocket that you could use to buy another home or invest, whatever the case may be. So a good use of credit is to borrow money to purchase an appreciating asset. Another good use of credit, and this is one thing I use with my credit card bill, I go over my credit card bill because it's a good detailed list of how I spent for the month. And it also shows me if something happened that I did not quite, allow. Things happen. People do things. You want to be able to trust people, but sometimes people do things that are not appropriate, especially if you hand your card to someone and they go away, like if you're at a restaurant or something. I did have something happen to me when I authorized a certain amount on my card, and the person proceeded to charge the whole meal on my card. So I saw the charge for that I authorized and the charge that I did not. But because I looked at my bill, I was able to dispute that and get it off. But my point is just that it's a detailed list that you can look at to see how you have spent using that credit card over the month. Then another good use of credit is if you pay off that total bill each month. If you do that, you avoid interest charges and you avoid the misuse of credit, which is keeping a running balance. Credit companies are kind of designed to keep you paying. Keep that in mind. They're businesses. So they would rather that you accumulate interest and keep paying the minimum balance. But if you do that, you will be paying a credit card perpetually, on and on and on. So that's one way of misusing credit. Simply because most of the things you purchase, you've already used, it's depreciated, or if you went and bought a meal, you already ate it. So try not to keep a running balance on credit cards. So that's the way of misusing credit. So credit has good use, credit can be misused as well. Now, if you find that you're keeping a running balance, let's talk about a get out of debt option that you may have, okay? There are a couple of get out of debt options that people use. One popular one, I don't know how popular it is right now, but it used to be very popular to consolidate. That's when you borrow money to put all your cards in one bill, and then you're paying that bill. Consolidation works well if you stop using the cards. Sometimes people consolidate, get a clean slate, and then just go right back out with the same habits. So if you do that, you're going to need to consolidate again. But if you consolidate and you have a plan for staying off of debt, then it's a good option for you. So consolidation is something to be considered, but you need to change your habits so that you won't be periodically consolidating. The second thing to look at is the pay the debt off plan, which is one that I would recommend. And I'm not saying that you can't use consolidation, but have an overall plan when you use consolidation. So a pay it off plan works like this. I'm going to step you through it. So first of all, you start with your lowest balance credit card or your highest interest rate card. By the way, you can find these plans online. It's amazing how much you can find online, whatever it is that you need. And then you can decide what works best for you. I prefer a lowest balance plan because it gives you some sense of reward. Think about it like a snowball. rolling down a hill, right? So you start with your lowest balance and you get that paid off, and then you kind of got a domino effect going on. You move to your next lowest balance and you pay that off, and you're getting some reward in the middle. Yay, I paid off a card. And then you can move to the next one, and it's like, how do you eat an elephant? One bite at a time. So I prefer a lowest balance because it gives you reward and it gives you momentum for paying off your debt. Now, whether you choose lowest balance or highest interest, I do understand highest interest because interest rates are high. If you do not pay off a balance each month, for bank cards like Visa and MasterCards, the interest rates are in the high teens, like 18, 19%. And then store cards are in the 20s, 25 or high 20% in terms of the interest rate. So if you keep that in mind, that'll motivate you to pay off each month or to just pay off your credit cards and then start managing them better. So you start with the lowest balance or highest interest rate card. Then, if you have any savings, use some of it, not all of it, but use some of your savings to pay down on the balance to just get you a good running start toward paying off the card. The other thing you can do is consider transferring the balance to an interest-free promotional cards. You can find these cards pretty much all year round. If you don't know where to look, go to bankrate.com. They have all kinds of interest rates. They have savings rates. They have promotional card information. So bankrate.com is your resource for rates of any kind, for any kind of financial situation. So consider an interest-free promotional card, transfer the entire balance to that promotional card and pay it off before the interest-free period ends. That's a part of your pay it off strategy. Now you could do that with each card, but still do it incrementally. Okay. So you focus on one card first. You may use that promotional card to pay that card off. And then once you start on your next card, you could look for a different promotional card to pay it off. You have to manage that though. But it is an option. If you don't use an interest-free promotional card, then you want to pay more than the minimum balance on your card, even if it's $5 or $10 more. And you keep chipping away at the balance on that card until you paid it off. Once you paid off that balance on that card, stop using the card. If you're using a lot of cards, that's one way to quickly overextend yourself. So as you start getting out of debt, you should decide on 1 or 2 cards that you're going to use for everything, and mostly bank cards because they can be used across the board in different places. When I say a bank card, Visa, MasterCard, Discover, those types of cards, American Express, those are bank cards. So that's what I mean by that. So once you paid off your first balance, celebrate inexpensively for paying off your first card. Then dig your heels back in and go to your next card, beginning the same process. As you're paying off, you want to put part of the payment that you were using, that you had used to pay off your first card. Part of that payment goes into your budget so that you can save money to reduce using the card again. And then part of the payment goes toward the next card. So you're repeating this process for each card. And then as you're putting more money into your budget, you will have money allocated to pay the bill when the bill is due. Hopefully that was clear, but if it wasn't, you just post on the YouTube video, post that you need more information, and I will be certain to provide that for you. Okay, so that's basically your get out of debt options and your pay it off plan if you are totally overextended with one card or even several cards. And what I mean by overextension, you're not able to pay the balance when each month, pay the balance off each month. Okay. So with that in mind, we're going to work toward as the year comes in, let's just decide to cultivate some good habits about our credit, starting with paying off our credit card debt. Okay. So now I'm going to move into your credit report and score basics. Okay. So we're going to start with what your credit report is. What is this thing that everyone's using to decide whether they're going to give you money or enable you to buy a car at a good interest rate? The credit report is simply a detailed compilation of your borrowing and payment history. It's compiled by credit bureaus. The particular ones are Equifax, Experian, and TransUnion. And they get their information from the lenders, the banks, and other businesses that extend credit to people. Okay. Some of the things that the credit report includes is your personal info, your account info, if you have a loan or something, that account info, public records, if you have filed bankruptcy or had some kind of interruption financially, that is on your credit report. And then any inquiries. And inquiries are simply when someone that's going to lend you money, that may lend you money, goes and looks at your credit report. That's an inquiry, okay? So the reason they're going in there is because they want to assess your credit worthiness. Basically, what they're doing is saying, if I loan this person money, am I going to get my money back? That's your credit worthiness, okay? You get a chance to get one free credit report annually, and you should request it and review it. And checking the report or reviewing your report does not change your credit score, okay? Keep in mind, most of the time when this information is being gathered, it is being gathered electronically. And therefore, there's a possibility of error on your credit report. This is one of the reasons why you want to review it each year. The other reason is just to see what is it? What is these credit bureaus have about your credit worthiness, okay? But you want to review it to dispute any errors. What are some examples? Wrong entries. And then especially if you have a common name like Barbara Williams or Mark Jones, because of the electronic compilation, there's a chance that someone else's credit information can end up on your report. So you want to check it and know that it is, in fact, your report information. You can dispute errors and get them removed from your credit report. So you really should do that, because if someone, for example, if they have on there, you have a bankruptcy and you never declared bankruptcy, that can affect whether a lender will lend you money. So you want to get that off of your credit report in the event that it shows up. So that's just some basics with credit reports. I learned something new that I want to share. You can add data to your report, to your credit report. You can add your payment of subscriptions, the apps that you get on your phone, and you could also add utilities. The website is Experian.com/credit/score boost. And I'm going to work with Wesley to see if we could get that website on the video or in a link on the video so that you'll have it. But you could add data to boost your credit report or give you, some positive data for your credit report. So with credit report basics, the obvious counterpart to that is credit score, because credit score is just a number that's calculated from your credit report data. So again, this is another reason why you need to make sure your credit report data is correct, because the credit score is calculated by the credit report data. So again, the score is just to help the creditors to determine their risk, the risk that they're taking with you repaying, whether they'll get their money back. The credit score also helps us determine our credit health. So it think about it like blood pressure. You know whether you have a blood pressure problem by monitoring your blood pressure. So your credit score helps you to monitor your credit health. Okay. And also, if you need to put stuff on to fix it or to make your credit health better, that website will help you to do that. Now, the one thing to keep in mind with credit scores is that if you have a high score, you're eligible sometimes for lower interest rate, which means you'll pay less money on borrowing money, which is a huge advantage to have. The lower your score, the higher your interest rate is going to be, simply because you are a higher risk if you have a lower score. So let's look at a couple of the things that impact your credit score. There are two scores that are used by creditors, your FICO score, and there's a Vantage score. I'm going to go over the FICO score calculation because that's perhaps the most popular score that are used by creditors. So 35% of your FICO score takes into account your payment history, how you're doing with, do you pay on time, those kinds of things. And then how much do you owe? Are you overextended with your credit? I think the rule of thumb for income to debt ratio is that if you owe more than 30% of your income, you're overextended. And people kind of look, that's kind of a red flag for you. So that's how that particular 30% works. Then you have the length of history for your credit accounts. When you have a long history and you paid well, that works in your favor because you have a long-term relationship with a creditor and they haven't had any issues with you. Then different types of credit experiences, like I said, your subscriptions or short-term loans, car loans, house loans, different things that, or even education, different credit experiences are taken into account. And then new credit, if you're establishing new credit. So all of these are factors, but the highest weighting factors are your payment history and how much you owe. So as I mentioned before, the scores that creditors use are FICO and Vantage. I mentioned this also. The higher your score, the better your chances of getting approved and your eligibility for a lower interest rate. And conversely, the lower your score, the higher your interest rate. Just want to look real briefly at the ranges for your credit report or your credit score, your score report card, if you will. So a typical range for credit score, the FICO credit score, is 300 to 850. If you have a credit score over 800 or over, you're considered exceptional. And that means that you will be approved, and most likely you'll be approved for a lower interest rate. Even if you're very good, same thing, 740 to 799. Good, you'll be approved. Your rate may be, average, if you will, 670 to 739. If you have a credit score in the 600 range, like 580 to 699, that's fair. You might have trouble getting credit, and you might have to pay a premium or a higher interest rate. And certainly, if you're in the range of 300 to 579, you may not be approved, or you may pay a really high premium for it. So we want to be working on our credit report card. And ways we could do that is by paying bills on time, paying down or paying off debt, settling or paying off past due debt. And again, updating your report with rent, utilities, insurance, streaming services, things that you are regularly paying. Ensure you add them to your credit card, to your credit report. So those are the things that increase your score. So as I conclude this segment on credit, I just want to go over some key things that are just good habits. As we move into this new year, we got time for a clean slate. We got time for doing things differently. And this is not a New Year's resolution, because this is a habit that we want to incorporate into our lives. So first of all, pay off credit balances every month. But don't despair. Don't stop there. If you have a running credit card balance, use a payoff plan to pay them off. And also, as you're doing that, put savings aside so that you can minimize the use of your credit card, and then you'll be able to pay your balances off each month. We're going to start requesting a credit report annually and review it for errors. And also to just let us know where we stand. Then, if we do see errors, take the time to dispute the errors, to remove them from your credit report. Then we're going to go to Experian.com. We can do this right away and add subscriptions or other eligible bills to our credit report to boost our ability to be approved for credit. And on that website, it actually tells you what the eligible things are. So then we want to look at continuing to pay our bills on time. And if we run into something, contact our creditors and let them know you may not be able to pay, and work out something with them. I want to reiterate that. Do not avoid people that you owe money when you may not be able to pay. People understand that life happens. And most of the time, at some point in our lives, we're going to hit a hard time. So the creditors do understand that. But the worst thing we could do is ignore them or avoid them. I remember I had a friend that worked with a utility company. And in a conversation with her, she told me, she said, the best thing that you could do to prevent your, utilities from being paid off is to contact the company. Tell them, I can't pay this, but I can pay this. She said, most companies will negotiate a payment for you so that, you can move forward and it not adversely affect you. So that's our information on consumer credit and the credit score and the credit report, and just some good credit habits that we can adopt, not just as the year starts, but any time in our lives that we have the opportunity to do, so that we can be better at navigating our finances. Thank you so much for listening. And as I said before, if there's any questions or anything, once you've watched the show, just put something in the comment section, and I will ensure to try to address it when I record again. Thanks, everyone. Have a great day. Don't miss out on valuable insights. Subscribe to our channel, hit the notification bell, and become part of our community dedicated to financial success. Let's embark on this financial journey together. See you in the next episode.